Hey, and welcome to Tax Talk with the Tax Queen. My name is Heather Ryan. I am also known as the Tax Queen.
Hey, today's topic is the tips to avoid an IRS audit. So, number one tip is don't round numbers. And what do I mean by this? Like, don't put, $10 here and $50 there. They should be strange numbers, right? Like odd. So, 731 versus 735 or 730. That's a huge red flag for the IRS that you're actually not tracking things properly and you're just kind of guessing at things. So don't round your numbers. Put them as they actually are. And this includes mileage. So don't put mileage as you drove 5,000 miles. Put it at the actual miles, right? 494,933, right? It should be the actual number you drove, and it shouldn't be a round number, or everything being a round number is a red flag. So number two is take all income. And what do I mean by that? So people report 1099, the NEC or the miscellaneous. So W-2s, even 1099 for retirement. So if you get a 1099-R, if you have investments and they earn dividends or you sold stock, all of that's being reported to the IRS in some way, shape, or form. So most of the times on a 1099 form, but it could also be on a W-2. So just make sure that you're reporting all of that and that you're not leaving anything off, because that is a computer can catch, automated. So when a computer finds, some kind of income isn't even showing up on the return at all, or it's not showing up in the proper place. I've also seen that. So you might try to take the income, but it's not put in the right category and the computer doesn't catch it, or it does catch it, I should say, and it flags it. And so you could get an audit for that, and it could be an underpayment tax, which is a really high penalty, and we just don't want that to happen. So make sure you're taking all your income and don't leave anything, off the table, we'll say. The other thing I would suggest if you are a business owner is don't use the term miscellaneous expenses. So chances are every item that you're taking as a deduction has a category it belongs to. And if it doesn't, and there's something industry specific, then create one. Create that industry specific category for you, for your business, and write it in. And if it's not a line item on the Schedule C or another area of the tax return, that's okay. They have other category and you can write it in what fits. And so if it fits for your industry, then they're not going to question it. But not taking everything or putting it under miscellaneous, even if it's $100 or $200 or $500, I just don't like to do that. So I always say don't have miscellaneous deductions. Categorize everything properly. And if you watch me at all, if you listen or read my blogs and my articles, I'm a huge proponent of not procrastinating and of keeping up with your expenses and your income on a monthly or weekly basis. So you're doing it throughout the year and you're not waiting until that last minute right before your tax return is due, because that way you remember what all the expenses are. And I feel like sometimes people would put miscellaneous expenses because they don't remember what it was for, and so they're just like, miscellaneous, that fits. So just make sure it's properly categorized and you have receipts, hopefully. So that's number 3. Number 4 is do not form a corporation just to save on taxes, or it's just or to avoid an audit, right? It doesn't make sense. So a corporation, whether you're a C corporation, or you elect SCorp tax treatment, can still be audited, number 1. And if it's not the right fit for your business and your income level, then why would you do that in the first place? It has a lot more things that you have to check boxes off. It has more regulations. It has an extra tax return. And I just don't do it to try to avoid an audit. Like, hey, I'm an SCorp, no one's gonna check these things. They still get audited, and it could still be a problem. And that kind of leads me to my next category, and is if you are an SCorp or a C corporation. So if you're treated as a corporation for tax purposes, or you actually are one, as you registered for a C corp, make sure you pay yourself reasonable compensation. That is tip number 5. So reasonable compensation is if you're working in the business, you have to get a salary for the work that you're doing. So it is based on whether you're working full-time or part-time, and where your geography, so where your business is located, what's your industry experience, all of that. It's all based on that. But you need to be paying yourself a W-2. And if you don't, the IRS can audit you. So yes, it can audit corporations, and it can take any owner withdrawals that you've done and reclassify them as salary or compensation. And now you'll have late penalties and failure to file for payroll taxes, and it's just a big mess, and I say avoid it. So tip to avoid an IRS audit is pay yourself reasonable compensation if you are treated as a corporation and you work in the corporation. And the last tip is to look at your expenses as a percentage to your income. So is it too high? Is it, are you taking all these deductions that you maybe shouldn't be? Because usually if a red flag is raised, if your expenses are too high as relation to your income. So I usually say, somewhere between 50% or more should be profit. So if your expenses are greater than that, it's just your chances go up to get audited. So, and why are your expenses? Maybe there's a good reason, and that's okay, but in general, make sure that you have profit, right? You're in business to make money, to make a profit. And so if you're not making a profit, then why are you doing this business? And the IRS might think the same thing. There can be explanations of if you're changing things up in your business, or if you had to do huge marketing because you're launching a new product or a new service and you just had to spend a little bit more money to get that going and get it off the ground. So there are explanations, but in general, if your business isn't making a profit, then it's not a very good business, first of all. And obviously this could be industry specific, so just be aware of that as well. But generally, 50%, if you're making more than that, that's great. If you get down to 40%, that's even better. And if you don't know about all that, I do suggest you learning about profit margins and understanding, your expense to income ratio. So there we go, the tips to avoid an IRS audit. Number one, don't round your numbers. Keep them as they are. It can be odd looking numbers, that's good. Take all your income, don't leave anything off of your return. If you accidentally forgot it, then file an amended return. Don't use the term miscellaneous expenses. If you have a business, make sure everything is categorized properly. Don't form a corporation thinking you'll avoid an IRS audit. And to piggyback on that, make sure you're paying yourself reasonable compensation if you are a corporation, particularly S corporation owners, but both SCorp and SCorp are responsible for that. And then look at that expense to income ratio. So, what are your expenses as according to your income, and make sure that they are reasonable and not too high, right? So there you go. See you next time.